Hey guys, what's up? Welcome back to my financial focus. In today's video, I want to talk about the long calendar spread, which is an options trading strategy that I have not introduced onto this channel yet. It's a little bit different from the other spreads that I've talked about in the past, which were specifically like the long iron condor strategy or the short iron condor or the put credit spreads, the call debit spreads, those kinds of spreads. All of those spreads are what are known as vertical spreads, but in this video, we're going to be talking about the long calendar spread, which is a horizontal spread. So thanks in advance for leaving a like. I'm going to try to provide as much value as possible in this video. So let's just not waste any time and get right into it. So the first question that I want to address, which is probably a question that a lot of my viewers right now have, is what is a calendar spread and how do we create one? So basically what a calendar spread is it's a spread that is created by buying one option and selling another option of the same type. So basically a call or a put option of the exact same strike price, but with different expiration dates. So in contrast, as we've studied in the past, a vertical spread is opened by buying one option, selling another option, both of them of the same type and of the same expiration date, but then they'll have different strike prices. So if I was going to open a call debit spread, for example, I would buy this and then sell this. So it would be two call options of the same type, same expiration date, but of different strike prices. With a calendar spread, I'm going to be selling, for example, in this case, the 123 strike call option. Then I'm going to go to a different expiration date, like say 1 month out, February 25th, and I'm going to buy the same strike price call option, but I'm going to buy it at a different expiration date. And then we can see in the top right corner that it opens up a long call calendar spread. And it's a call calendar spread because I'm using calls, and it's long because I shorted the near-term option and then I went long on the long-term option, which is what makes it a long call calendar spread. And then it's obviously a calendar spread because I'm using two call options, same strike price, except different expiration dates. And so what ends up happening here is the way that we profit from owning a long call calendar spread, or in other words, what our objective is with this spread, is for the short near-term option to lose extrinsic value faster than the long-term option. And so what does that mean exactly? Well, if I go back to where I shorted the 123 strike call option, right here, just to sum up, long calendar spreads, or in this case, a long call calendar spread, they profit if the share price of the underlying asset, in this case Alibaba, stays like near the strike prices of the options that I shorted and went long on. So in this case, since I'm opening the long call calendar spread right next to the share price at about 122, the goal for our long call calendar spread is for this to trade sideways. We want the share price of the underlying to trade sideways. That way we experience the max profit, because as we can see from this chart right here, the further the strike price of our calendar spread moves away from the share price of the underlying, the more we start to lose out on our max potential profit until we eventually start eating into the total cost, in other words, the max loss of our calendar spread. On top of that, the reason why the option loses extrinsic value faster if it's the near-term option is because the closer the option gets to expiring, the faster theta decay starts to eat away at the value of the option. So we can see right here that the short call that I shorted for my calendar spread has a theta of about 38 cents. So basically what this means is that with each passing day, all else being equal, so like if the share price stayed the same, if everything stayed the same, with each passing day, the premium of my short call will start to decrease at about 38 cents per day. So right now it's at $4.13. It'll decrease at about 38 cents per day with each passing day until it gets to the expiration date of January 28th. And the closer and closer we get to the expiration date of January 28th, the more theta decay increases. So the time value of the contract starts to decrease further and further the closer and closer it gets to expiration date. And so by contrast, we can see that the short call has a theta of 38 cents, whereas the long call has a theta of 12 cents. And so we can see just from this example alone that the call option that I went short on, which is the near-term call option, which is going to expire sooner than the long-term call option, it has a higher theta decay value, and so it loses extrinsic value a lot faster than the call option that I went long on. And that's the objective, basically, of how somebody profits from a long call calendar spread. They're essentially just trying to collect premium on the call option that they shorted faster than they lose premium on the call option that they went long on. So in this case, the long call calendar spread is a positive theta position because it profits more and more as time passes up until the expiration date of the short call. Because once this short call expires, the position that we'll have will essentially just be a long call. We won't have the short call anymore. We'll only have the long call. And so we won't have a short position after our initial short position expires that will allow us to collect premium against the premium that we lose for the long call. And so in this particular case, let's say that upon expiration date January 28th, the share price of the underlying asset stayed the same, traded sideways that entire time, and we were able to collect the full $413 from the call option that we shorted, that we sold, or wrote, whichever rhetoric is chosen. Then in that case, we would still have the long call option that expires on February 25th, and we would just be able to short another call option. So let's say that after this expires on January 28th, and we only had a long call position expiring February 25th, that we just went to February 4th, and then we just shorted the 123 strike call option expiring February 4th. So this one would expire because it's January 28th, and we would have collected the full premium at that point, and we would only be left with this long call position. And then at that point, we would just short another call option at an expiration date that is closer to expiring than the long call. So in this case, February 4th. And then we would essentially collect the premium from the short call again. And so we would be able to continue collecting premium on our short call just so long as the expiration date of our short call is closer than the expiration date of our long call. And so another way that this calendar spread can be viewed is essentially just a way for options traders to minimize their risk if they're going to buy a long call option anyway. So let's say that somebody was just planning on buying a long call option for February 25th right here. Obviously, if they just buy this long call option, then they're going to incur a total cost of $840. And on top of that, theta decay is going to be eating away at their position with each passing day, right? Because right here we have theta decay of 12 cents, or in this case $12, because with options contracts we're dealing with 100 shares. So we just multiply all of these values by 100. So this total cost would be $840, and with each passing day we would lose $12, right? So if somebody's going to buy a long call anyway that expires on February 25th, then something that they could do in this case to minimize their risk would be to short a near-term call option. That way they would be collecting $38 per day from the call option that they went short on versus the $12 per day that they would lose on the call option that they went long on. So in this case, the best case scenario for someone who opens up a long call calendar spread like this would be for them to basically experience no volatility up until the expiration date of their short call. So in this case, January 28th, as long as the share price traded sideways that entire time and the short call expired slightly above the share price of the underlying asset, like it's positioned right now, the short call would essentially expire worthless because it doesn't have any intrinsic value. Obviously, a call option gives us the right, but not the obligation to buy into an asset at the strike price. So if the strike price is like down here at 119 and the share price is trading at 122, we can buy in at 119 and sell at 122. So it has like $3 intrinsic value, right? But if the short call option is trading slightly above the share price of the underlying upon expiration date, then it expires worthless because it has no intrinsic value. And the extrinsic value is made up of the amount of time that is left for the call option to move in a favorable direction. So on January 28th, if the share price of the underlying was below the strike price of the call option that we went short on, it would have no intrinsic value and it would have no extrinsic value because there's no time left and the strike price is above the share price of the underlying asset. And so in this case, so long as the share price trades sideways, we would collect the full premium here. And as soon as this short call expires, we would be left with a long call position that's expiring on February 25th. And then in this case, obviously, if we're just holding a naked call position, the best case scenario for us here would be for the share price to just spike upward after our short call expires worthless, because then we would collect the full premium from the short call and we would be able to experience the unlimited profit that comes from an appreciation of the underlying asset when we're holding on to just a naked long call position. So that's one outcome. And then as I described before, another outcome would be if we just continued to short more call options after each short call option expires worthless, up until eventually the long call option would expire worthless as well. And so this basically just sums up like how we can profit from this long call calendar spread. And the last thing that I want to point out is why we want the share price of the underlying to trade sideways in the first place. Because obviously right here we see this graph and it says that if the share price of the underlying moves significantly away from the strike price of our call calendar spread, that it would start to experience a declining value. And I'm just going to explain why that is. It's a little bit complicated, but I'll try to keep it as simple as possible. Basically, what's happening here is the options contracts are appreciating faster as a result of delta than they are depreciating as a result of theta. So that might have sounded a little bit complicated, but I'll try to sum it up in a beginner level understanding here. So we can see right here that delta is worth 52 and theta is worth 22. So what that means is with each passing day, all else being equal, the premium of this short call is going to decrease by $22 per day. So we're collecting $548 for shorting this call. And with each passing day, this call option would lose $22 of value, which if we're shorting it, that's value that we're collecting, right? But because delta is 52, let's say that even though one day passes and this option loses $22 of value, if the share price of the underlying increases drastically, let's say it increases by like $10 or something, then that would mean that this 123 call option would be where this 113 call option is. And so even though the call option loses $22 per day, if the share price increased $10, the value of the premium of this call option would appreciate from about $548 to $1243. So even though it loses $20 per day, if the share price increased $10, it would increase by about over 100%, up to $1,200. And so that's the main reason why even though time is passing with the long call calendar spread, if the share price of the underlying moves drastically, we'll start to lose value because the difference between the premiums of the call options when the strike price is near the share price is greater than the difference between the premiums when the strike price of the underlying is further away from the share price. So to sum up, right here we see $840 minus $548 is $292, right? And this is when the share price is near the strike prices of the call options. Well, let's say that instead of the call options being right next to the share price, that we were to choose the 113 strikes, right? So let's say we shorted the 113 strike call on February 4th, and then on February 25th, we bought the 113 call, right, at 14.45. So right here, we can see that the difference in the premiums between the 123 calls is, what was it? It was about like 200 and something dollars, right? Whereas the difference between the calls of the 113s is $202. So the difference between the value of the premiums for the call options that have a strike price that are further away from the share price is $202, whereas for the call options that have a strike price that's right next to the share price, if we were to buy this one and then short February 4th, this one, it's $292. So we can see that when the share price of the underlying asset moves drastically away from the strike prices of the call options in our call calendar spread, it starts to depreciate in value. If this was further away from the share price, it would decrease in value from 292 all the way to 202. And that's why when the share price of the underlying moves further away from the strike prices, that we start to lose value, and why we want the share price of the underlying to trade sideways in order for us to experience the max profit. That way we don't lose any value on our long call calendar spread from delta, basically just messing up the value of the premium of our call options, but then we continue to collect the theta decay that's moving faster with the short call at about $22 per day, as opposed to the long call, which is at about $12 per day. Pretty simple strategy, in my opinion. It's a strategy that benefits from theta decay, similar to just selling like covered calls or something, or selling cash secured puts and collecting premium that way, except it also opens us up to the opportunity of profiting from the unlimited profit potential of the long call after our short call expires worthless. Like, comment, subscribe, all that good stuff. Definitely leave any questions, comments, or concerns in the comment section below. I'll link another video in the comments that shows the danger of opening different spreads like this, because I'm probably going to get a couple of questions from people asking me like, what happens if the short call expires before the expiration date shows up? And I already made a video addressing that, so I'll leave a link to that in the description and also in the comments, so definitely go check that out, and I'll see everybody in the next one.